Namaskar. Welcome to this Think and Link series. I'm your host, Srinivasan. Last Friday, that is the 3rd of May 2024, Reserve Bank of India released a draft prudential regulation for banks, NBFCs, financial institutions pertaining to loans and advances to projects under implementation. And this circular created quite a stir in the financial sector, which shares of banks, NBFCs, infra funding institutions tanking by more than 10%. You all are aware that markets have a quicksilver reaction to policy announcements. Why the markets reacted to this proposal the way they did, it is difficult to comprehend. After all, this is just a draft proposal in public domain, and it is yet to be confirmed. But then we cannot question the collective wisdom of the markets. They see what the general public don't see and are also far-sighted. So let's discuss this issue threadbare. The issue of prudential norms for projects. To begin with, let's understand about projects and project funding. Now, project finance involves public funding of infrastructure and other long-term capital-intensive projects. For example, financing of power projects, ports, roads, which require huge amount of money running into hundreds and thousands of crores. Most of these projects have a very high risk profile, a long gestation period, and uncertain cash flows. These are the hallmarks of any infrastructure projects for that matter. Now, unlike a regular loan sanction, which would depend on the character, capital, capacity of the borrower, right? The loan structure of a project financing relies primarily on project's cash flow for repayment, the project's assets, the project's rights and interest of that project. And of course, these form the part of a collateral, but the lender would also be assessing the project sponsors, their experience in handling and commissioning the project. This will also be a factor that is reckoned with. So these are some of the important aspects. Further, the project funding could be through a consortium of several lending institutions. It could also include loan syndication. I mean, it could have any sort of funding proposition. Now, having said all these, a project has essentially three distinct phases. One, the design phase. Secondly, the construction phase. And third is the operational phase. Now, banks and lending institutions' skin in the game comes in at the construction and the operational phase, where the money is lent and outstandings appear in the books of accounts. Now, post is, of course, the extant prudential framework of income recognition, asset classification, and provisioning kicks in. So, this is the current scenario. Now, in the draft prudential framework which the RBI recently released, that is pertaining to loans and advances for projects, the regulator has proposed a stricter regulation for project financing. So, in short, it makes it more expensive for the lenders to provide loans for infrastructure and industrial projects like roads, ports, and power plants. So, the question is, what has changed and why? And that is the question that we will try to answer in this session. Firstly, let's get into the why part of this. In the previous infrastructure lending boom of 2008 to 2015, banks whitewashed their books about, hid bad loans and defaults, forcing the central bank to launch an asset quality review. This led to unearthing of thousands of crores of rupees of hidden bad loans. That resulted in what? Investors losing money. NPA levels in the banks shot up to an all-time level of 6.11 lakh crores. And the government having to invest more than 3 lakhs in the capital to bring back the banks into shape. Also, the bank's past data showed that many project loans were classified as standard assets, even after some of them were delayed by as much as 6 years from the scheduled deadline of completion. And it was also not generating cash flows. So, this is the rationale for proposing a stricter lending criteria with additional provisioning. And all this is aimed at preventing accounting shocks that could potentially hurt the balance sheet of these entities and their valuation multiples. The planned measure for prudent. These planned measures are prudent from risk management perspective, stemming from the regulator's experience in the previous credit cycle. Of course, we all know that experience is a great teacher. Now, coming to the second part of the question, what are these regulations? Now, here I will touch upon the draft legislation or the draft proposal on a macro level basis. Viewers wanting to read a complete draft regulation can click on the link provided at the end of the video. So let's see the current scenario, the current guidelines. Currently, banks set aside 0.4% of the project loan amount for exposures that are standard assets. So when I say standard assets, it means good accounts or accounts that are not in default. The new norms require the lenders to set aside 5% of the money that have been lent as general provisions for all and existing new loans. Plus, the new norm also requires 1% provision even after project completion. Now, this is more than double the existing provision. So, how it will work is the central bank aims to increase the standard asset provisioning to 5% of the loans from the current 0.4%. It is going to be done in a phased manner. So, standard assets would have 5% provisioning covering ratio during the construction phase. It will be reduced to 2.5% once the project reaches the operational stage, and further cut to 1% if it achieves certain financial benchmarks. Infra lending also suggests that banks will have to classify a loan as non-performing if project is delayed beyond 6 months of the original stipulated deadline or the date of commencement of the commercial operations for which additional provisions have to be made. Perhaps the RBI's proposal to impose 5% provision requirement on project loans might have been triggered by the expected credit loss norms, which require banks to make provision based on past experience of default. Now, just for your information, the expected credit loss approach recognizes losses on loans as soon as they are expected to occur, regardless of whether the borrower has actually defaulted. So ECL norms, that is the expected credit loss norms, are prudential guidelines in keeping with the global best practices. Whenever ECL norms are notified, banks will have to set aside provisions for defaults based on their experience, which means it will be or it could be over 5%. The draft rules will apply to financing of projects in infrastructure, non infrastructure, and commercial real estate sectors. Having said this, let's understand what the market reactions were after the draft regulations were released. So, shares of state owned banks, NBFCs, and infrastructure firms plunged as much as 10% on the Monday following Reserve Bank of India's tougher draft guidelines. The plunge in the infrastructure stock stems from the concern that banks and NBFCs might have to transfer a part of the higher cost to the borrowers through increased interest rates, which means there is going to be a likelihood of interest rates rising up. So, what is the impact? While the guidelines will hit lenders from the time they come into force, right? One of the great advantage of these norms is that earnings and provision numbers released by these lenders will have a greater credibility and higher level of trust among stakeholders and investors. The guidelines will also improve credit discipline and ensure that only serious players, and I'm talking about serious players in the lending as well as in the borrowing segment, only such serious players will participate in project lendings. The incremental credit costs for public sector banks are expected to be in the range of 12 to 21 basis point as per seasoned bankers. And some of the news reporters have said that according to finance professionals, the new regulation could be detrimental to the growth in capital intensive infrastructure. But others have also said that these new regulations could reduce competition for companies such as PFC, that is Power Finance Corporation, REC. But the professionals are also sure that if the rules are confirmed, it will not affect the P&L statement of the company. Once a project starts operating, lenders can reduce the provisioning to 2.5% of the money lent. If the project is performing well and has sufficient cash flows to repay the loans, the provisions can be further reduced to 1% of the money lent. Of course, lenders who have a higher share under construction project with longer gestation period may have to face sustained impact on the capital adequacy. It could prompt banks, NBFCs, infra lending companies to replenish their capital to meet the regulatory requirements, strengthening them. So, as I said earlier, most of these projects, infrastructure or industrial projects, they carry a high level of risk and have a long gestation period and also have to contend with uncertain cash flows. These are the hallmark of a project, and therefore we need stricter and tougher norms, especially now that India is aiming to reach a developed status by 2047. So I see this regulation as positive development. So with this, we wrap up our discussion of stricter regulatory measures for infrastructure lending. Thank you very much. See you in another episode. Bye bye.